To finish off the week this week, we welcome the CEO of Elemental Royalties, Fred Bell. Hello, Fred.
Hi, Mark.
And how are you?
Very good. Thank you for having me on the podcast. I'm excited.
Yes, welcome to the podcast. It's our first time talking about a royalties company, so I'm looking forward to learning about it. And Kenny, you're there as well?
Yep, I'm here. Yep, I'm in Scotland. It's a bit brighter today. We always do a weather forecast in Scotland. It's looking a bit nicer, which is good news. It's been rather miserable the last couple of weeks. Good to speak, Fred. And bizarrely enough, I mean, we need to tell this story first of all, before we get into the sort of meat of the podcast. I had been in discussions, I think, with is it Dustin, one of your directors, on Twitter, just having a chat backwards and forwards, and he happened to mention, you should speak to a guy in the UK. He's a guy called Fred Bell, and I thought, you know what? I said that I know Andrew Bell's got a son called Fred, and I've actually met you about 12 years ago, I think, Fred.
yeah, that's probably about right.
You must have been in early 20s, perhaps, by then, or something.
That's exactly it. Yeah, recently, probably recently graduated not so long ago from Edinburgh University. So up near you, and that would have been right. Yeah,
so it's a really, really small world, and I had a wee chuckle when I seen the connection coming up. But no, it's great to have you on the podcast, and as always with our directors and CEOs, we like to get a bit about their past. You know, what done in business, what motivates them. You know, what you've done in your childhood education. I mean, it's really up to you, Fred. You can go back as far as you want and tell us how how your journey's been and how you've arrived at Elemental Royalties. The floor is yours.
Okay. Well, fantastic. That's a really broad scope for me, and I suppose it's quite nice because I can sort of talk from my perspective of how I see it, I suppose. And I think the main I suppose way I arrived in a royalty company is as you mentioned, it was the family connection to mining. And so, you know, I think from the age of about 17, I was learning about the mining industry. But as a history undergraduate, I never actually expected to end up in the mining industry. I thought it would be a useful learning experience, more from the corporate side, and I would get to see close up an industry that prior to that I hadn't been involved with in any way. And so throughout my time at university, I worked or I did work experience internships with various AIM junior exploration companies, I think, on the whole. And it was a really good insight into the industry. And I had always thought I would end up as a investor on the investment side, on the buy side. And so at university, I started investing in AIM, really mining and exploration companies predominantly. I did do some others, but that was actually a really good way to learn as well, because it meant I was calling up CEOs, and I might only have had £1,000 worth of shares, but I was calling up CEOs and asking them questions and quizzing them, and that I learned an awful lot from that. And I think I learned an awful lot about the importance of engaging with private investors. Yeah. Because, you know, at that stage, if somebody wouldn't speak to me or if the company wouldn't respond to me, you know, generally I saw it as a pretty negative thing. Whereas sometimes, you know, companies, and it didn't have to be the CEO, but if the company was willing to give me some time, and I wasn't trying to take up all their time, but if they were willing to respond to me, to come back, to try and answer queries, point me in the right direction, whatever it was, it's really helpful in terms of getting up to speed and understanding. So that was a really useful perspective. And then coming out of university, with a history degree, I ended up in a sort of work experience internship for what is now part of Investec. And it was as a real estate, working with the real estate analysts. And I probably thought I would end up with a call it a nice, safe job in the city, and then it was through my dad, Andrew, and he said, Fred, there's this insolvent shell listed as it was then on, I think, the Next Exchange, formerly ISDX, and he sort of said, look, I think that the company's doesn't really have any projects, but it is an open vehicle, and they want somebody to do something with it. And I actually remember at the time I was pretty skeptical, and I had seen how difficult it could be in the exploration space, and I remember talking to my mum, and she said at the time, don't do anything in mining. This sounds terrible. Stay in a nice job in the city that's sort of safe, and get on it. But Dad could be pretty persuasive, and I ended up joining. It was called Le Sungway, and anyway, I ended up. I think the first job was sort of flying out to Malawi, and
it was rare earths, wasn't it, from memory? I think rare earths.
It was, sorry. Yeah, it was. Yeah, it had. Yeah. That's right. And Malawi actually had it doesn't have a lot of exploration, but uranium and rare earth were two of the areas where they did have some historical exploration work, and I ended up through that experience. It was pretty painful, if I'm honest. My first job was to fly out to Malawi, paying for my own flight, to let the staff in the subsidiary go and effectively tell them that the company was insolvent and the subsidiary was going to be wound up. And it was supposed to be done by the previous management. And somehow it ended up being me 2 days into the job, having to go out there and do a pretty unpleasant job. And at a young age, I think it was, you learn a lot from it. And I probably spent the next year or two in my free time the company had a sort of small drill rig in Malawi and one or two other assets, and actually managed in the end to sell some of those to other companies, and get some money for those employees in Malawi. But it was ended up then with this sort of clean shell in Malawi, and at the same time, a company in Australia, again, which I had connections to, and they had just relisted with a project in Malawi. Now, when I say they'd relisted with a project with Malawi, there were only 3 companies in Malawi at the time. There was really Paladin with their Kailikira uranium mine they were building. There was Globe Metals and Mining, which was a Perth-listed company. And then there was this company in Australia. And so I had just gone out to Malawi and essentially dropped our licenses and closed down the subsidiary so that this shell would survive. And this ASX company had just relisted with projects there, and unfortunately their CEO got very ill straight after listing and had to resign. And so the other director there was someone called, or the other, I think the CEO there was Richard Evans, and he's actually, funnily enough, a director now of Elemental with me. And Richard, they needed someone to hold the fort in Melbourne, and they needed someone who knew Malawi. And just a quirk of fate, having just returned from Malawi, they said, Fred, will you come out to Melbourne with 2 weeks' notice, and essentially hold the fort while we sort of work out management changes. And so I flew out to Melbourne. I pretty much with almost no notice, and I ended up I planned to be there for a few weeks, and I thought it would be a really good way to meet the only other 2 companies in Malawi, and I ended up staying at this company with Richard, and effectively I became general manager, and Richard was in charge from the technical side, and I think CEO, and effectively we ended up, Richard and I, running the company for for sort of a year following that. We had a drill program in Malawi that was going on. We had some exploration projects elsewhere, and Richard, who had been nearly 20 years at Western Mining, the BHP port, and a very good technical background. So I learned a lot working with Rich, and at the same time, the shell that I had and I was keeping alive, and it had applied for some licenses in Malawi, and in the background, it was sort of continuing to progress projects. And so anyway, after a year of being in Australia, it was a great job. It was really hard work. It was very stressful, thrown in at the deep end. But I learned a lot working with Rich. I did work really, really hard when I was there. And when I finished my day job for Resource Star, I went home and I had to do things for this shell that I was still, the only sort of employee of, but I, wasn't paid anything for. And anyway, after a year, I had a great experience there, but I was also quite keen to move back to the UK. I had never planned on sort of staying in Melbourne, and so I came back to the UK, and this was 2012, and I think my view was that the mining space at that time it had recovered from the financial crisis, and I thought that this is a good opportunity for me to try and progress these projects in this shell I've got and take it up to AIM. And I think although we had got one or two of the licenses we had applied for in Malawi, we didn't get one of the other licenses. And alongside that, my view was that specialty metals like rare earths, they're quite a niche product. And, it often isn't the discovery of the project that's difficult. It's how you process it.
Yeah.
And I thought, look, this is going to be a really, really tough sell, because even if you get a good project and even if you end up with a good resource, there's an awful lot of work, years probably, that need to go into working out the metallurgical side and the processing side. And that's, so far outside my area of comfort, and probably outside the area of comfort of a lot of investors. And so this probably isn't the right kind of project for the company. And so I started looking for other projects. Looking back on it, I didn't then have anywhere near the contacts and experience I have now. So I was sort of, lucky in a way, but I came across a project in Northeast Ghana, and it was a gold project, and it was owned by a private company, primarily people here in the UK who had funded it. And it was interesting, but I think what was more interesting about it was Northern Ghana. And Ghana is a top 10 gold producer globally, and the second biggest in Africa after South Africa. And the more famous belts, the Ashanti belt and elsewhere, are huge gold producers with world-class mines on it. And in the northeast of Ghana, because it was more remote, it actually hadn't seen any real modern exploration at that point. And it was the only gold belt in Ghana where you could go and pick up a license over huge swathes of it. If you go to the more famous gold belts in the south, you're picking up sort of real estate, 20 square kilometer blocks. Whereas here, you could go and get 700, 1,000 square kilometers. And actually, in terms of artisanal production, so this is small scale, locals working it, it was the second largest producer of artisanal gold in Ghana, which is a testament to actually, the potential there, without having seen any modern day exploration. And there was a mine just across the border on the same gold belt. So from my perspective, I thought, okay, look, we can't buy this project. It's too expensive. It doesn't quite fit. But what we can do is go and look at some of this ground in Northeast Ghana that is really interesting and in some ways analogous to Azuma, who had a district scale land position in the northwest of Ghana. And so ended up going, to cut a long story short, we signed JVs over two of the licenses, both of which Randgold had. And we managed to get all the data from Randgold over those. And it gave us a really good, they had narrowed down from a much larger area and honed in on these two licenses. And so we managed to raise some money, appointed some directors to the shell with these two projects and took it towards AIM listing. Once you're up and running, at any point, you probably don't have one of the sort of 3 or 4 licenses you need, because each one can take months to get renewed. But for a listing, you have to have all of them in good standing at the same time with the listing. And so by the time we took it to market, it was about July 2014 when we did the roadshow, and we actually raised the money to list. And I think everyone said you wouldn't be able to. And it was a very tight budget, we really had to pare things back. Valuation was so low. We had a mid-tier miner that was going to come on as a cornerstone shareholder post-listing, the sort of $1 billion plus West African miner. And they were going to put some projects in the company as well. And so I thought, look, this is going to be a really good Northeast Ghana focused explorer. And albeit valuations were terrible at the time and sentiment was very, very negative, I thought it's actually still a pretty good place to start in a country like Ghana where there is an established mining industry. And when we got the commitments for the funds, the listing document goes to the exchange, and the exchange actually came back and said, look, I'm sorry, but we think you should be an investment company, not an exploration company. And I think it was under Rule 15 at the time. They said, look, you have option agreements, not full ownership of these projects. And so we're taking a view from now. And it was really due to a company before us that had just done an RTO. And they said, look, we don't want this now to set a precedent. So we'd like you to be an investment company. And it was, it sounds like a small change, but it's a change in terms of our documentation, needing a new competent person's report in Ghana. I mean, it's 9 months minimum of work if everything happens in Ghana on time. And the frustration was we could get 100% ownership of both licenses for $300,000 in equity post-listing. And so we even said, we'll do this on day one if necessary, and then we'll own the licenses outright. But I think what they were particularly worried about was the precedent that a company could essentially circumvent. If you wanted to get onto AIM as an investment company, you could take an option on a project, list, and then drop the project straight away, and you've essentially got onto AIM, through a side route. And so they actually said, no, you have to come back as an investment company. And at this point, I think having spent 2 years plus in this as the only employee in the company, so I was the only person doing it full time, the entire listing, I wasn't getting any experience. I wasn't learning from anyone. I was getting paid, less than I think I had been paid sort of at university on sort of summer jobs. So I sort of thought, look, this is a huge amount of risk to take on for someone of my age. It's pretty stressful going through a listing when you haven't done it before and you don't have a lot of assistance and you're doing it on a very lean budget. And at the same time, valuations are down probably 70%. But, this profile of exploration from where it was when we started. And so I couldn't leave the company because I think it would have just folded at that stage. And so we actually merged it with a private company who had a gold project also in Ghana that had a resource on it and was adjacent to something that we were looking at, which gave it some additional critical mass. And 2 of the guys there joined as directors as well. And then we were starting to take it back to AIM for a listing again. And at that stage, I had been thinking about it from a personal perspective. And from a personal perspective, I just came to the inescapable conclusion that for someone at my age profile, I should either go and work for a bigger company and get some more experience and bide my time, or if I'm going to stay in the setting up a company, the higher risk route, I'd like to do it in a business model that doesn't have all the issues I encountered with Goldcrest. And the one I could see in mining was the royalty model. And so I ended up resigning from Goldcrest and saying, look, guys, I'm here to help, taking it to listing wherever I can. Get in touch with me, if needed. But I can't afford to spend another 2 years, going through the listing documents, essentially almost not being paid. And so at that point, I left and I set up a few months later Elemental Royalties as a private company. And the person I got in touch with was Richard from Australia. And I'd done a fair amount of work into the royalty model. And I think what I really liked about it was if you get producing royalties from day one, and that's far harder said than done. I'm sure everyone would like to do that. But if you can get good quality producing royalties from day one as a private company, you'll be cash flow positive. And as soon as you're cash flow positive, you are in a different position to 99% of the exploration companies out there. And you are, to some extent, master of your own destiny. And, the other thing I found with Goldcrest was, as a very small listed, and it was ISDX exchange company, as a very small listed company, the costs and bureaucracy are sometimes totally disproportionate to what you are spending on the ground. And throughout this listing process, there was so much work that had to be done with the exchange, with auditors, with nomads, with accountants, with competent persons reports, that was necessary, but wasn't adding any value on the ground. And I sort of concluded that, look, for a very small company, like we were at the time, that didn't really make sense. And so if we could start Elemental privately, if we could get, and we had from the beginning 18 shareholders, pretty much all in the mining industry, and some really good quality names in there. If we could get those shareholders and put a company together that's cash flow positive, we could raise money when we wanted to raise money, and to some extent on our own terms, rather than being forced to go back like I was with an exploration company and raise money, and you're at the mercy of investors who naturally want to get the best deal they can. And that isn't necessarily the best deal for your existing shareholders. So that was really the genesis of Elemental. And I think the reason why the royalty model appealed, because you get a lot of the upside and you can take away a lot of the risk once you have producing cash flowing royalties.
Yeah, obviously the projects are mature as well in the royalties model, which always helps. But it's quite a journey for such a young age. So it was almost like an apprenticeship you served. I mean, that was about four years before you arrived at Elemental.
Yeah, I would probably say trial by fire more than an apprenticeship. I think that experience of being listed in different countries and the different operating regimes and seeing projects, across the spectrum, and also, wearing my investor hat on a personal level. It's given me a lot of really good experience that I don't think I would have been able to get at a bigger company.
Yeah, definitely. No, there's a lot of life lessons learned, and you might have thought it was painful at the time, but maybe 10, 15 years from now, you'll be like, I'm glad I'd done that. I wouldn't have changed it for the world, because it's made me into the person I am now, or made the company into the company it is now. So just for the benefit of our listeners, Fred, and possibly myself, and probably Mark as well, I'm not really aware how the royalty model works. Can you give us a quick overview?
Yeah, and it's such an interesting point, and I think you've just touched on it there, which is the royalty model as a whole. It's primarily in North America. Canada and the US is really in mining where it originated, and there are the 95% of all the royalty companies are listed in Canada and the US, and as a sector they have outperformed gold as a commodity. For example, they have outperformed the mining index by a long way, but they are relatively unknown as an investment in the mining space in the UK and Australia, and that's a really interesting aside. And so I think it's if I had known sort of more about royalty companies from a younger age, I might have invested myself. But the basic concept of a royalty company is that you are taking a small, call it a 1% slice of the revenue of a project or a mine, and you generally take that as a 1%, for example, of gross revenue. And so if the mine is selling $100 million worth of gold a year, you have 1%, 1 million of that comes to you each year. And the critical thing here is that you are insulated from operating costs. So I think in the sort of the big mining boom, what you saw was commodity prices rose. But as commodity prices rose, so did all the operating costs, labor, fuel, all the inputs rose. And as a royalty company, you're insulated from that. So the mining company might be selling $100 million worth of gold a year, and they might be making $20 million of profit. You're getting, 1 million from that and directly linked to commodity price. So you take away a lot of the risk. And for that reason, royalties are, they have very good downside protection. If commodity price falls by 10%, in that example, the miner goes from 20 million profit to 10 million profit, and they lose 50% of their profit. And the rest is operating costs. As a royalty company, you would go from $1 million to $900,000. So, the operating miners have a lot more leverage on the plus side or the negative side. But I think the reason royalty companies have worked so well is partly because mining is a very cyclical business. There are a lot of ups and downs, and we have a lot of risk in the industry already. And so if you have investment that is got a lot of downside protection, doesn't have exposure, it doesn't have as much, I suppose, direct correlation with the profit margins of miners, then you're in a really good position. And the second point about this, and this is a crucial one, is as a royalty company, you don't operate any of the assets. So we are now coming into this listing, we're a 55 million Canadian dollars market cap based on the fundraise we did. And we have royalties over 5 producing mines, and 4 of those are paying us at the moment. And so if I was to draw an analogy with AIM, I would say that on AIM, you might find 100, 150 companies in the mining and exploration sector. And I think of those, about 7 or 8 have diversified revenue. That is revenue from more than one mine. Well, we're coming in here as a relatively small market cap, and we already have revenue from 4 different operating mines with 4 different mining companies in 4 different countries. And so
protection built in there.
So absolutely. And COVID was a really, really good example of this. And, obviously it's been a very difficult time for a lot of people, and mining companies haven't been immune to it, with travel restrictions and trying to take precautions for workers. And one of our royalties on a mine called Aminkaya in Chile, they reduced the number of employees by 25% to try and help, and there was a reduction in the production there. Now, if that had been our only asset, that would have impacted us a lot more. But because we had 3 other royalties that continued uninterrupted, and actually in 2 cases had their best quarters, you already see the benefits of that diversification, because we have continued really without pause throughout that, and we've been able to do it because we're diversified. And with every royalty we get, we are more diversified, and we have lower risk than we did the day before. And so that's a really great advantage, is you get, number one, you get exposure to typically gross revenue. So directly linked to commodity price, you're protected from the operating costs. Number 2 is you don't operate any assets, so your overheads are incredibly low. And the biggest royalty company in the mining space is called Franco-Nevada, and it's been around in one form or another since the 1990s. And it is probably a $20 billion market cap, and it has about 32 I think employees, maybe 31 or 32 employees. So I'll just repeat that again. It's about a $20 billion market cap, and it has about 20 employees. And since they were acquired by Newmont, and then they were spun out and relisted again in 2007. And since they were relisted in 2007, they have given over 20% capital annual growth rate in their share price. Now, for a company to do that,
staggering numbers.
It's staggering. But for that period of time, people often do it for a few years, but to do it now for 13 years is phenomenal. And the third reason that I think is really important why they've been able to do that is you get the exploration upside at no cost. So when we buy a royalty on a mine, and we recently bought one on Teranga's Wangyon mine in southwest Burkina Faso, and that mine has about 1,000 square kilometers of license area. Now, we don't know this, but it is likely the 13-year reserve life that mine has. Over time, it's likely they'll continue to grow that and add to it. And what you see in a lot of more mature mines is you see a mine that was built 20 years ago with a 10-year mine life. And today, it still has a 10-year mine life because they're continuing to explore, they're continuing to find new resources, and they're continuing to add it into the mine plan. And so if you bought that royalty 20 years ago and you bought it on the basis of a 10-year mine life, you probably got repaid after 7 years. And then you now have 23 years of it mining and continuing to pay you. And when you add that with other royalties and you're diversified and you have low risk, you suddenly have this incredibly powerful business model that you can keep going. And then once you get to a certain size and scale, you can start to borrow money at a very low cost of capital. And so the big royalty companies, they're borrowing, they're able to borrow hundreds of millions of dollars at LIBOR plus 1%. And that is a cheaper cost of capital than, any of the major mining companies. And so, you can start to see how, wait a minute, if I can be in a royalty company it has 10 producing royalties, it can borrow money cheaper than even the biggest mining companies. It has very low costs. So even in a downturn, if commodity prices come off by 30%, it's not going to affect them because they only have 5 employees. You can start to see how that business model works really well in the mining space.
Yeah, it's a very, very efficient model. So it is. So the focus is gold then, Fred. And I see there's a bit of silver in the commodity suite and some mineral sands, but are they just byproducts of the particular royalties that you've picked up, or is a focus on other commodities?
So it's yes, I think we're focused on precious metals, and what we'd like to do is we'd like to keep it 80% weighted towards precious metals, and we're open to other opportunities if they arrive. The royalty we have on mineral sands is on Base Resources, which is AIM listed here in the UK and ASX listed, and that's actually a tier 1 mine on the cost curve in the mineral sand space. That's a really high quality mine, and we were able to buy a royalty on it when it was an operating asset that paid us back in under 2.5 years from acquisition. And so, it was too good an opportunity not to do it. And we've always said we'd stay open to those kind of opportunities, but I think really important to keep the commodity weighting towards precious metals, so predominantly gold. And if you look across the sector, the royalty companies tend to trade at anywhere from 15 to 25 times earnings multiples, and they trade at sort of 1.5 to 2.5 times NAV. And that's a huge valuation premium to sort of miners and development companies. And I think that tends to be more pronounced in precious metals royalty companies.
Definitely. Sorry, Mark, myself and Fred have been talking quite a bit here. Have you got anything to add?
No, you've answered quite a lot of what I was going to ask. So as I understand it, you, as a royalty company, you buy a royalty in a miner, which they can use for their operations, and then you effectively take a percentage of the profits. That's the model, isn't it?
Yeah. And it's not a percentage of the profits; it's a percentage typically of the revenue.
Of the revenue. Right. Okay. Yes. Yeah, that makes sense.
So that you're insulated from operating costs. So you have some scenarios where commodity prices come off. There's a downturn.
Yeah.
The mining company might not be making any money. In fact, they could even be losing money in the short term, but you are still getting paid a royalty.
Right.
Typically, these royalties are usually held by a third party. It's not, well, in my experience, it's not the miner that tends to hold them. It's the private company that probably had it before the miner.
Oh, okay. Yeah.
Yeah. Really good point. It's that's really where we started, because when we started off as a private company with just a good idea, and no good quality mining company, and the market capitalization of the companies we have royalties over is probably an average of 200 or 300 million, and none of those needed to create a royalty on their mine for $1 million from us. And so what Kenny said is that was, finding existing third-party royalties is exactly how we got started. And whether it was someone who held the license years ago, whether it was a landowner who was given a royalty, whether it was another mining or exploration company that sold part of their project in and took a royalty as part payment, those were often the scenarios where we could get really good quality royalties. And I think the average counterparty that we've dealt with to date have been billion-dollar plus companies who had these as very legacy assets, and in one scenario forgot they even owned the royalties until we approached them. And so it enabled us to get some really good quality royalties on good quality assets that we wouldn't otherwise have been able to do from a standing start.
Is there a better time to be involved in royalties, or a better market? Is it cyclical like the mining market is?
I think it really does impact our ability to transact. Is dependent to some extent on market conditions. It's also, there's a distinction between buying an existing royalty and creating a new one. And if you're creating a new royalty, that is easier in some ways to do in difficult equity markets, because operators would always look at a royalty as an alternative to equity. And so if valuations are depressed, you saw a lot of very big royalties in the hundreds of millions of dollars each being written in the 2014 to 2017 period, when the markets weren't good. And a lot of big companies said, look, we can basically sell 1% of our gold for the next 20 years, and we can get $200 million in cash today. And that is going to be much better for our shareholders than trying to dilute ourselves and raise 200 million at those prices. So I actually think that when markets are not very good, that's a great time to be creating new royalties, because it's a very compelling proposition for mining companies.
Yeah. Okay.
And otherwise it's probably a good time to be buying existing royalties.
Okay. And you mentioned at the start about if you can get a royalty that is cash flow positive, that's like the holy grail, if you like. How likely is that? And then obviously if you're getting a royalty that's where a company that is more in the explorer stage, how can you balance the risk there? Do you have a sort of strategy to deal with that?
So at the moment, our portfolio, we have 6 royalties and 5 are on operating mines.
Okay.
So we are unusual in that for a younger royalty company, you typically might see a profile which is 10 exploration royalties and 1 or 2 producing royalties.
Okay.
And we've gone about it the other way around and said, okay, from the outset, the most important thing to start with is a diversified revenue base. Because if you can start life with diversified revenue, you can then build up from there, and you can build out your pipeline. And so I think that we really wanted that foundation at the beginning that gave us a measure of security, that gave us a measure of diversification. And now as we're going forwards, we can start to look for, yes, still producing royalties, but also we can look at royalties that are at development stage or at the exploration stage. And because there's no holding cost with a royalty, if we can use some of our revenue to buy really good quality royalties over assets that we think are going to add a lot more value in years to come, that's also a good approach.
Okay.
So ultimately, Fred, you guys are about to list in the TSX. Now, I know you can't really say too much about the listing because obviously it's very close within the next couple of weeks. But is there anything you can say about the listing?
So I suppose what is public is that we're doing a reverse into a Canadian TSXV listed shell called Fengro, and it will change its name to Elemental Royalties Corp on completion of the RTO. We did a fundraise that was announced and closed in June, and we went out to raise $15 million Canadian, and we had a very positive reception. We ended up more than 2 times oversubscribed, and we raised 24 million, which is conditional on the listing completing.
Mm-hmm.
And so we are hopefully should have some updates on the listing front very shortly, and we'll be able to put out a timeline on it. But I think in the next day or two we should have I think a much clearer idea on the exact timing and sort of plans. But
yeah, it's quite a potential war chest. Was it 24 million? You said, wasn't it, Canadian dollars?
Yeah, and so as a bit of background, we actually, for the last acquisition privately, for the first time we used a sort of material debt facility. So we used $8.5 million US loan to acquire it, and so I think part of the plan is to repay that, or the majority of that loan facility on listing, and so we will we'll come out with cash and a clean balance sheet, but we will also have an acquisition facility through that same group of up to 20 million US. So I think that, from day one on listing, we're able to look at deals that are genuinely in the $20 to $30 million space, and we can execute on those straight away, which is something that we could never do as a small private company. And that's so important, because coming into this fundraise and coming into this approaching the listing, we had 50 shareholders maximum, and we had 2 institutional shareholders who came in our last private fundraise, but our ability to transact was sort of $5 or $10 million was probably the limit. Whereas now, for the first time, we're coming in, we're going to have more cash than we've ever had in the company. We're going to have an ability to use our listed equity that we haven't had as a private company. And we're going to have a $20 million US acquisition facility that, again, we've never had before. And so I think that although we're new to the royalty, to the listed markets, we're not new to the royalty business. And so there are a lot of opportunities we saw when we were private that perhaps we were constrained in being able to execute on, and that I think now, coming through this listing, we will have an ability to progress.
Yeah, that was fantastic, Fred. Obviously you've explained the royalty model. I mean, I had a basic understanding, but you've laid it out there in layman's terms, and it seems to me that you're creating a virtuous circle almost. So appreciate the time coming on. I think we're probably just about done. Mark, have you got any other questions for Fred?
Well, the only other thing that I was perhaps quite interested in exploring, maybe just for a couple of minutes, Fred, is just, as this is the Market Musings podcast, maybe just going back to your university days when you started investing. Do you remember the sort of companies you invested in, and what was your success like? And if you're happy to sort of say if you still invest today, and maybe give us an idea of what you're involved with?
Yeah, absolutely. It's funny because there's actually a company I remember from university days called Shanta Gold.
Okay.
And in those days, it was still an explorer. And I remember thinking back now, probably 14 years or so, and I think being a shareholder in Shanta Gold, and I now see them, and they're a producing gold company in Tanzania, and they've done very well recently. And it's funny sometimes when you go into investment bank or brokers' offices and you see the tombstones on the walls of deals they've done. And it's amazing how many of these projects were around 12 or 13 years ago in one form or another. And I think that's a really interesting, point of view from the mining side, is that often, it's not the first time somebody's worked on a project. It might have had 2 or 3 companies before, and it's taken those 2 or 3 companies to advance it to where it is today, where, maybe it's on the cusp of being turned into an actual mine. And so you often do see those companies coming through again. And thing I learned probably, and in terms of how my investments went at university, I came out the same as I had gone in.
Right.
So I didn't make any money, but I didn't lose any money.
Okay.
And one of the things I learned was, and this is, I used to hear people say it when I was younger, and I didn't fully appreciate it, that management is so important. I think now, having been working in the mining space for probably all in, coming on for 15 years of sort of being involved in it. And I think you really do appreciate how much value a good management team can bring. And, you have to understand why people are in it. And are they in it to genuinely turn it into, a really serious business? Or is it a sort of, I don't want to say a lifestyle company, but is it a sort of, take it easy, just keep it going, don't take it too much. And I think that the management track record, reputation, I think that's one of the key things that if I went back in time, I would look out for in the space. And to be honest, if I went back in time, I would probably also buy some shares in royalty companies.
Yeah, okay.
The ones that are around then. The other thing I would say as well is probably when I was younger, I had a very concentrated portfolio. I think I probably had initially, 2 or 3 companies that I really liked, and I sort of, had all my investment between them. And I think now I would probably have a more diversified portfolio, and it actually enables you to take advantage of, one company might really outperform in the next 6 months coming, and maybe then you can exit that, and if you still like the other companies, you can then redeploy some of that in. But actually, I would be more diversified now than I would have been when I was younger. And so I think that's something else I've learned, because at the end of the day, mining in particular, there's no getting around it. It is a risky space, and that offers fantastic upside. But you also have to remain wary that it goes both ways. And so I think keeping that diversified portfolio, hopefully enables you to do better in the whole.
Perfect. All right. Well, I think we're done here, Mark. I appreciate the time, Fred. I'll be keeping an eye on the news flow over the next couple of weeks, and as soon as I see you guys listed, I might touch base again, and we can get you back on for an update, if that's okay.
Yeah, absolutely. That would be brilliant. Thank you both very much for having me on, and I think covered a lot of points in it, and I think some really, really interesting ones, particularly for investors like me, before I started Elemental, who in the UK, there isn't the same familiarity with the royalty space.
Yeah, no, it was very interesting. Thank you very much, Fred, for talking to us.
Yep, perfect. Okay, have a good day, Fred.
Thank you.
Cheers.
Thanks, then. Bye-bye.
Bye.
Thank you for listening to another podcast from Market Musings with Fairbairn and Russell. Tune in next time.